Because that's what everyone's worried about as well. Because if you go directly and you do it yourself, you obviously don't pay as much fees as you would be paying if you go through an asset manager or or stockbroker as well.
You know, my view on fees is it's related to value. So, you know, if you in your mind don't want to diversify through Adrian or through any other product on the JSE, and you buy the share because you believe it's a good share and you've done your homework and you've done a fundamental analysis and you understand the business, and in your mind it's a good buy, and it costs you 100 Rand to do a 500 Rand transaction, but you believe that there's value in that company, then the fees are irrelevant in the scheme of things, as long as you perceive value. If the fees are too expensive, buying that one share, well then you've got to look at other ways of getting access to the equity markets, and there are a whole lot of other products that can do that at a much lower cost.
Adrian, how do you weigh it up though? You know, for people out there wanting to invest and in two minds about whether to go at it directly or indirectly, surely there must be some kind of ratio that one could work out and say, well, you know, perhaps can an asset manager is looking too expensive or looking relatively cheap in comparison to others?
I think the product market, if we can call it that, and I shudder to think that I belong to that, but the product market is actually very competitive. You can shop around for fees, but you're going to find very little difference. The material differences will be between the type of product that you go into. So if you go into an index fund, an exchange traded fund, on balance you're going to be paying much lower fees than if you were to go with an active manager, which is Canon Asset Managers, for example. The next question is, well, how much bang do I get for that buck? And invariably, if you're going to an exchange-traded fund or an index type portfolio, you're going to be getting very good value for money, because overwhelmingly most active managers struggle to beat the market, yet they charge you a higher price for that displeasure.
Okay, Noah, let's give the day traders a bit of time here as well. I know quite a few day traders and they have aged over the last 6 months. No surprise, because they are playing the volatility, and of course it's a tough game, and of course there's a difference between speculating and being an investor as well. If you do want to go about it your own route and you've got the time, you've got the money, and you're not worried about losing any amount of money, what do you suggest for the viewers out there?
Find yourself a stockbroker with those kinds of parameters that you just put onto the table. Stockbrokers will be falling all over themselves to have you as a client because they make money every time you buy and every time you sell. So you know, find yourself a stockbroker. Most of the large banks have got online brokerages. There are a whole host of other brokerage houses that would love to have you as a client.
Okay, Adrian, what fundamental factors do you look at when you create your funds as well? And give us some insight into that. And also, when someone is looking at various funds, and obviously you've got to weigh it up and look at, you know, the competitive environment, do you go for something that's heavy resources, heavy consumers? I mean, at the end of the day, you're the one that's deciding on which kind of companies you're putting into funds.
Look, I'm not sure that Noah and I agree on this point. I think that if you are going to be investing directly yourself, the first thing that you want is to be absolutely passionate about the market. I think that you want to have a keen interest in understanding what you're invested in monitoring it, and staying abreast of issues. From there is a very broad spectrum of the way in which you can approach the investment decision. I belong to a very small community of investors known as contrarian investors. So by definition, we go and look where people are least interested, where they've got the least passion. We go and look at companies where there's just, you know, general disinterest, there's malaise, there's, oh well, you know, there's far more exciting things on the market than this cluster. Now, my experience is, and this is not unique to me, this is a global result, over time, contrarian investing delivers by far the best results amongst active managers. The problem is the caveat over time. Have you got enough time to be patient and wait for this result to be delivered?
How much time are we talking about here?
The average holding period in my portfolio, 5 years.